We can see you and hear you.
And why does come sneaky squeaking noise? But maybe आपके यहाँ से multiple people has login, right? That's maybe that's
Yeah, I'll take care of that.
no. Give me a heads up when is a good time to start, okay?
Sure, I'll let you know.
Thank you.
Trilok will start in a couple of minutes. Still 2 minutes to 4.
Sorry, I was on mute speaking. Gaurav, I was just trying to pull out the presentation in the meanwhile. Is it visible?
Yeah, I could see the presentation. Yes, I can see it.
Okay, cool. Sounds good. Because in this we can't. I mean, I can't see it simultaneously on the same screen. Yeah. So
Okay,
I
I
thought
can
it's
see it. You can go on the view part on the full page thing.
okay. Got it. Cool. Sounds good.
Trilok, I think we can start. Can you hear me?
Yeah, I can hear you.
Okay.
Uh,
So,
I will
give me a minute.
start the
Yeah,
presentation.
sure. Give me a
Give me a
minute.
minute.
So let me just welcome everyone. So good evening, everyone. Thank you so much for joining us today. With us, we have our fund manager, Mr. Trilok Agarwal. Trilok manages our mid-cap strategy, which is known as Ambit Good and Clean Mid-Cap Portfolio, and our small-cap strategy, known as Ambit Emerging Giants Portfolio. Trilok has over 16 years of experience into investments and equity research. Before joining Ambit, he worked with Diamond Asia Capital and Aditya Birla Sun Life Insurance. In his previous stint with Aditya Birla Sun Life Insurance, he was a portfolio manager managing fund across various mandates. He was also entrusted with managing shareholders' funds and delivered superlative performance consistently. So today, Trilok will take you through his market outlook and especially on the small cap space, and then some bit on our emerging giants portfolio, and then we'll open the floor for Q&A. You can simply type your questions on the chat box. Over to you, Trilok.
Thank you, Gaurav, for the kind introduction. Good evening, everybody. Thanks for joining us on this evening to understand what's the outlook on the markets and what are we thinking on the small cap. So before I begin, I would actually, just take you through a quick, snippet on what happened YTD. So, calendar year till date, we have seen a massive outperformance by the mid and small cap names. Thanks to, I would put this way, an end to uncertainty with regards to the interest rate, particularly global markets, as well as uh, the probability of recession, kind of receding both in developed markets, US and UK in particular. In India, on the domestic front, we were anyways doing very well. We had no issues whatsoever, either in terms of growth rates or in terms of credit or in context of what kind of economic outlook are we sitting at. So India was never, and even in historically, India was never a problem child. The problem always hit us from the global perspective, whether it's US, it's Europe, or some other issues which develop. Even at the beginning of the year, as you guys remember, or I would just like you to refresh your memories. Between Jan and March, we obviously saw a series of new age banks in US particular, which either almost filed for bankruptcy or actually almost closed, sort of shut down, which obviously this time around was intervened by regulator to get acquired by stronger banks in the US, which obviously not only I would say prevent, but also completely averted any kind of issues that the system could have faced in case these banks went bust. So this year, obviously, as I just alluded, mid and small cap have participated sharply in the performance on a broader level. Importantly, what's led to that performance? Obviously, one of the big sort of feed. So if you think about it, usually markets are associated with two things. Any stock price will performance will have two important angles to it. One is valuation, one is earnings, and second is liquidity. So there is no to denial about the fact that liquidity in this particular system has been strong, particularly in the small cap space over the last few months. So much so that the large cap have actually been negative over the last 3-4 months, and complete sort of money has been sort of moved into small caps. Now, we have to bear in mind that this swing of money is also a function of a very a prolonged period of no performance in this particular category. To give you a context, until March 2023, the 5-year return composition of the small cap was less than 10 percentage points. That I'm talking about CAGR basis from March 18 to March 23. So not only has we and during this time frame, the earnings of the small cap was in an excess of 15 to 17% CAGR. So not only did we see a derating in the small cap, but also we had an impact with regards to what markets were actually sort of investing in. And during this time frame, we saw the kind of COVID and in the recovery and so on and so forth, which not only impacted the asset class but also impacted the way investors were chasing this particular asset class. Now, uh, obviously, liquidity is also a strong inflows. Is also basically corroborated with the fact that we are also seeing a very strong inflow of SME IPOs. Also, small companies who want to basically hit the bell, particularly in the BSE NSE, is also gone up so sharply. That's usually been the case even in historically as well. Nothing very different this time around. However, one thing is very different, that the participation by the retail has gone very, very sharply compared to the last cycle, where institutional or a large money was actually, a very few pockets or very few hands at large, money investing in small cap names. So this time it's fairly widespread compared to the last concentrated flows that we saw. Importantly, as I just alluded in my previous comment, two things which matters. One obviously is the earnings, and second is most important, as I just alluded, was the flows. Now, if you think about it, what kind of earnings we have seen. This is just a depiction of the chart that you can see here. This is nothing but we have divided the small cap 250 into five quintiles. We have done we have again ranked them basis on companies who deliver consistent earning growth, or have been actually delivering earnings growth in this Q1 and is it now visible?
Yes, we can see it.
There's something wrong with it keeps going off. Sorry for that. So
Just do the
yeah, I was
full
saying that.
screen view, please.
Yeah, I'm just trying to do that as well. Just give me a sec, please. This is better right now.
No, it's still the same.
Just give me a sec. I think so. This. Now it should be better.
Yes, we can.
Sorry. So yeah, I'm just saying that again we have just done a earnings momentum, earning growth driven. What kind of performance the mid and small cap companies, small cap in particular, has given, and then we obviously rank them on a quintile basis. So when you look at this particular performance, is clearly the stock performance is visible. The companies who deliver better earnings growth have clearly performed significantly ahead of what the market has delivered. In fact, to almost 2x of what the BSE small cap did, and the companies who obviously have seen meaningful moderation, or sort of different growth, have seen and not only sort of made less money, but some have lost money as well. To give you a context, I will obviously name a few companies to give you a fair perspective. Natco Pharma is one of those companies in the small cap which have delivered significantly better earnings, and delivered in very, very strong returns for for the shareholders. Credit Access Grameen is another one. Triveni Turbine is one of those. Uh, I you know Again, India Mart is another company. Jyoti Laboratories is one of those. So these are the names that I can just comes to my mind. In a Q1 which has delivered over a long period of time good numbers, and also have maintained growth momentum consistently. Now, important thing to note. भाई मेरा वीडियो कॉल चालू. So this is clearly showing the different performance of the different companies across different time frames. And these are the names that I highlighted in the Q1. In the Q2 also, if you just think about it, there are companies that just to give example, who have long history. Apar Industry is one of those. uh, KEC International is another one. VGuard Industries, Sarah Sanitary Ware, Anupam Rasayan. So these are the companies who have done good over a long period of time, has participated, in bouts of good performance and weak performance every now and then. However, they clearly showcase what kind of difference they have delivered in the performance for us as investors and for earning growth for the company as well. Now, important thing to also note is whether this particular style of investing works during only one particular cycle, or has it been time tested. So our understanding and belief is not only has this worked in this cycle, but obviously has, as can be seen from the chart itself, is time tested over a period of time. In fact, in 2019, 2009 as well, post GFC, even in 2014, if you remember, when the European crisis happened, particularly from the Greece, from the almost Greece economy was supposed to go bust, and even post 2018 when we saw a massive, I would say, downfall of mid and small caps for 2018. This particular divergence is very very clear that companies with good growth have has meaningfully outperformed and delivered a strong performance across time frames. And those who obviously, so in the quintile five, which is the last, or the companies who deliver the least sort of growth, have lost money across time frame and not made money in majority of the time frame. In fact, in the latest one, 2018 till now, the performance of that is just merely 4% versus the BSC small cap of 20% plus. So this is clearly testifying the fact that it works across cycles. This is again corroborated by the fact that you can obviously talk about time to time, point to point returns, but what happens when you look at a rolling return? Because one, every investor has a different time frame, has a different horizon, and a different entry and exit point in the particular markets because of his own risk profile as well as his own past track record. Now, the interesting point I want to highlight here only is 3-year rolling return, because 1 year rolling return also is clearly showing outperformance, but 3 year is always the better way to judge a particular asset or a particular investment. So again, reiterating, Q1, quintile 1 and quintile 2, which is the top two quartile basically, has consistently outperformed a 3 year rolling return over a period of time. Now, the flip side is, what happens of the of those companies who don't deliver in growth rates or are actually having a weak momentum growth rates. So you can see clearly, not only have they delivered badly, but in majority of the cases they have lost capital for investors. The 3 year rolling return, as you can see over the last 15 years, is clearly underperforming benchmark by a large margin. And this large margin, usually these are the one who actually also brings down the index performance as a whole. Because if you just to give you a context, if you leave this aside, the index performance itself can go up by 300 to 350 base point on a CAGR level. However, life is like that. Only you have to pick and choose the best among the small cap, and you cannot obviously just differentiate or sort of segregate the wheat from the chaff unless you are a astute investor, or you actually follow a very, very disciplined approach of investing. With that, obviously, and what is the important message I also want to leave you guys with? What happens in small cap investing is you need to basically stay invested for a long period of time, because if you don't invest and you try and time the market every now and then, not only will you sort of lose money, but your ability to create sort of large capital, or you to ability to basically ride the whole the whole tide will be actually left out. So to give you a context, the average here, the data showcase the average market cap of a small cap company from 2015 to 2021. Also, it showcases what kind of shift that has happened from one category to another. So, as you can see, there is a significant massive wealth creation has happened when you talk about 2021, from 2015 to 2020, where every year, around between 45 to, between around 25% companies move from one category to another. So, and that happens over a period of time. It doesn't happen in one particular year. So you need to stay invested to obviously reap the benefit from a longer term perspective. Now, obviously, one question that most of us always have and will obviously have is what happens in case there is a, markets will obviously have give opportunity every now and then, and there will be volatility. So if in case the market obviously sort of sees the volatility, what happens to our funds, what happens to, our sort of investment strategy and philosophy. So I would like to, delightfully share that not only during good times our performance obviously is good, but during downturns our, whole philosophy of investing in good companies, strong governance companies, and, companies who can ability to generate their own growth in going forward, have surpass meaningfully well during difficult times. So this is example of two flagship schemes, which is a mid cap and a small cap fund. So as you can clearly see the alpha generation during difficult times, because of the inherent core strength of the portfolio, is anywhere between 500 base point to, 1500 base points. Obviously, and this is time and tested across three different years: CY18, CY19, CY20, where we saw what happened, post the last meltdown. Because obviously this is the data I have, because prior to 2015 the funds were not in existence, so no point of, making that statement, that particular comparison. So that's the perspective on what we think on the small cap. I'll also, quickly take this opportunity to, run you through what the emerging giants or the small cap strategy that we are obviously offering. Important thing I just highlighted, right? We have a very, very strong framework of good and clean framework, where we actually identify the companies who have the ability to grow consistently. However, importantly, that is been identified by applying an accounting framework, which basically have all P&L, balance sheet, cash flow accounting principles over a period of 5 6 years. And then we also have a great, governance clear framework, where we actually don't invest at all in terms of what companies or what there, if there is any iota of doubt in governance in any particular company. So this actually leads to, from a 500 stock of universe, when we actually apply these two particular important good and clean governance framework, we usually evade, or, sort of avoid around two-thirds of the companies, because they don't meet the sort of cut, or they actually not even meet our criteria. So out of a handful, I would say one third of the total companies that meet the criteria, we end up, constructing a portfolio of 15 20 companies that not only intends to deliver at a consistent basis, but obviously idea is to, generate alpha over a long period of time. And we have been able to consistently do that. I'll obviously take you through going forward on that performance bit as well, how is the long term performance. But this is a, framework that we follow, which I just highlighted. Accounting is one of those important framework, and the second most important being how the company is able to grow without, resorting back to external capital every now and then. uh, this is obviously a clear, investment. So this portfolio is eventually an outcome of what process that we follow. Not only we clearly emphasize on the quality of the businesses that we invest, but eventuality is that companies that becomes a part of the portfolio are either leader in their particular or challenger in their particular segment, will obviously with extremely low on net, net cash companies, are obviously have the ability to, uh, deliver consistently because of the strong capital allocation in the past and led by strong leadership team, and will obviously has ability to consistently grow going forward as well. Now this is all of that has reflected in what our performance has been. So, not only have we delivered a 500 basis point alpha over the last, since inception of this particular fund, but even, in a market like this, who actually sort of, seeing all things flying off the shelves, we have done a fairly, I would say, decent job in context of what's happening in the markets. So the consistency of the performance also matters, and every year, if you look at calendar year basis, we have beaten the benchmark handsomely, and even from a quintile perspective, we are meaningfully better than what most, competitors would have offered. This is, at last the portfolio composition. When we actually talk about emerging giants, is that it is a fully small cap portfolio with more than 90% invested in small cap, significantly better beta of the portfolio, given the fact that the company invested are either challengers or, leaders in the niche segment. And we have also seen a meaningfully lesser sort of drawdown in the difficult in the past years, and the ROEs of this particular portfolio is almost 1.6x of what the index offers, which obviously is the right reflection to evaluate when you look at the price to earning multiple compared to the benchmark. And clearly, I would leave you guys with the fact that this is a well diversified portfolio, unlike the traits of a small cap where the sector is not been focused of. So we obviously look at the bottom up strategy, and that's the reason, despite the bottom up strategy, we are fairly diversified in the way we have exposure across the different sectors. So with that, guys, I'll sort of leave the floor open, or I'll take give it back to Gaurav to moderate the session for Q&A that you guys may have.
Yeah, sure. Look, so we have our questions. So, uh, so we have a question from Mr. Harsh, and he
Yeah.
wants to know that in the last slide, was it rolling returns or CAGR?
The last slide that I just presented was emerging giants. What was the CAGR return?
Yeah. Okay. Okay. We have another question from Mr. Weber, and he wants to know that if you can just summarize the key takeaways from the webinar. I think from the valuation point of view. So, just key takeaways in terms of where do we stand with respect to small cap.
So, there is no denial of the fact that valuations of small cap have caught up lately. But the key summary to take away from this particular webinar is in the medium to long term, earnings matters. And I've shown across cycle 2005, 2009, 2015, 2018. Despite the fact that markets went up in a frenzy during those time as well, companies with consistent growth have actually come out with flying colors over a long period of time, whether you take it 3, 5, 10, 15 years. So earnings matters is what I want to leave you the message with. Second important message that I want to leave you with is valuations in certain pockets where have become expensive, but if you stick to quality businesses, that will not, I'm not saying in case the downtime happens those will not fall, they will also participate in the downfall. However, quality business usually are usually will fall less than the subpar quality businesses that these days are running off the mill. And lastly, I would say that make a fairly good choice in what kind of portfolios that you allocate your money, or you advise your investors to allocate money with. You might, some portfolios could deliver, uh, I would say, exceptional returns in a very short period of time, but be prepared for a very very sharp volatility when the things turn around as well. So these are three messages I want to leave, or summary that I want to leave you guys with.
Thank you. The next question is that the small cap index has gone up by 44%. Does that leave room for more upside, or should we wait for some correction? And another question is, should we invest in EG right now? So both are linked together.
Yeah. I got this con. So I always keep going back to this example of a 5 year return, because usually any, so again 44% in the last 3, 4, 5 months is obviously a function of what, from where are you seeing from. It's a point to point return, but when you look at a 5 year CAGR return, from a 5 year CAGR, mid cap small cap index is not even delivered a 20% CAGR, or not even 15% CAGR. So the point I'm just trying to highlight is, from again go back to a quarter or so, March 18 to March 23, small cap index would have delivered around 10 odd percent, 10ish or 9 odd percent return, whereas the earning delivered was 18% plus. So we saw a reasonably long derating of the particular index before we saw a change in the stance that what market adopted. So we think the right question is, whether we think earnings growth of these companies will actually see a massive downturn, or are we seeing earnings going down the cliff over the next 6, 12, 18 months. The answer is no. Whether there could be volatility during the time frame, the answer is definitely yes. But do we see upside from year on basis on pure fundamentals? Answer is definitely yes. So that also corroborates with the fact that, is it a good time to invest in companies or small companies or a portfolio like emerging giants? We always maintain this point that if an investor has greater than 3 years of view, one should invest in a particular, in any particular small cap name, because in the matter of 6 to 12 months, there could be very very uncertain events which nobody will be able to predict. But somebody, as I just showed in the previous slide as well, a 3 year rolling return across cycles have delivered significant better returns. So Gaurav, you want to pull that up again if you can, if you have the data, 3 year rolling returns, because that only clarifies the point, if is it a good time to time the market or not. So that's on slide number 7. So that will
I'll
obviously
need
clear
time for
clarify.
that, Trilok. I have to correct. Give me a minute. Till then, you can take the next question, which says that our top three sectoral bets and some, top three are bets in terms of our stocks. So, top three sectors
So
that we are
yeah,
focused on, and if you can give some
so the
example
top
in
three
each
sector
sector.
bets is clearly obviously visible, right? So consumer discretionary, financials, and auto ancillary are the top three sectoral bets that we are going with. We think India is at a cusp of from going $2,000 to $5,000 in terms of per capita income, and consumer discretionary names will be the best. I mean, the biggest beneficiary in the medium term for that particular rally. Financials, obviously, good quality small cap financials are the testing. I mean, are important sort of, I would say, engine for the economic growth, and that's the big reason why we are obviously betting on an auto ancillary, because we believe auto ancillary will participate meaningfully in the export opportunity from India, and that's why we are very constructive on that particular name as well. So these three are the top three sectors that we are sort of running our positions with. Yeah, so this is important. When I said 3 year, is a time frame that someone should actually think of. So yeah, so this is clearly depicted in the fact that if you invest in good quality growth companies, so not only will you do well, but it is actually they have done well across different cycles. We are not saying that there won't be any downturns in case an situation turn otherwise, but obviously the resilience of the quality of the business shows the sort of comeback will be equally strong, and one will be able to make money over a longer period of time.
Thank you. We'll take our next question, wherein Mr. Vikram wants to know what kind of returns can we expect this year.
So, Vikram, I would be very honest in saying that it will be difficult to quantify the absolute return, but I'll be, the way I look at the earnings growth of the companies that we are investing, or at least the earning growth of the small and mid cap company, should be in excess of 18 to 20% for this year, and subsequently even next year as well. So there is no reason to believe there will be a massive de-rating in the stocks or the companies that we are invested in, and one should probably expect a growth of in context or in line with the earnings growth that the companies will deliver. So between maybe I would say from here on, low to mid teens number should be a fair expectation from somebody, if I would be thinking from a 12 to 24 months point of view.
Also, in continuation, he wants to know that is the valuation on a higher side, and the cycle of small cap portfolios at least for 52 months. So, your take on that?
So yeah, so I agree. Small cap should be think from a 3 to 5 year point of view, but I wanted to just showcase 3 year rolling return. That's the best way to judge how the small cap, because most people and most investors would like to obviously have would like to reap benefits of the good cycle, but 50 to 50 months to 60 months is usually a time frame where a lot of things changes. But we thought 3 year cycle will help you to understand how things have sort of progressed in the past, and that's the reason we keep using that particular data point. Nothing and you're right, time frame is a better way to judge small cap performance, because in short term time frame there could be various economic and global events that can lead to steady underperformance, or any meaningful outperformance for the particular space.
Thank you. Mr. Harsh has a question, and he wants to know that for small caps, so what should be our strategy to invest? We should look at STPs or lump sum at this point of time.
So I have been advising most of the new investors that depending on the risk profile of an individual, I would sort of ask them to make their own choices. But if you ask me, uh, you know I keep going back to the fact that if you have a 3 year plus view, to be honest, a 5-10% correction, if the market gives, doesn't make any difference. So that's my honest submission to you. Although I'm not making a statement that the market will continue to go at one way, there could be some volatility for sure. But a lot more money has been lost in anticipation of correction than actually in the correction. That's the learning, and that's the experience of the last many years of investing, and that's the biggest sort of, I would say, regret that people have. Why didn't they invest, and why did they wait for correction?
Thanks, Trilok. Another question from Mr. Sachdeva. Your take on defense, railways, and power stocks.
My honest take is market is pricing too much too fast too soon in railways and defense in particular. Power could have a longer term opportunity, particularly with respect to, because thermal power and renewables have actually uh, seen a upsurge or resurgent in capex after 10 to 12 years. But defense and railways, I'm not, trying to rule them. It will start falling off the cliff. But I think too much is optimism is priced in the particular sector, and we are already thinking what's going to happen in FY 27-28 for us to make meaningful money from here on. So I am not, I mean, very very constructive in these two names. So obviously, power stocks still have some deep value, and which is why they might probably see some upside even from here on. That's the way I look at it.
Sure. Your views on healthcare as well.
Healthcare, I would divide into two parts: pharma as well as hospitals. I think pharma, after a prolonged, I would say, pain has come out of the US generic pricing issues. I think US generic pricing issues are behind. Domestic pharma companies are doing exceptionally well. Even in CY 22, they did very well. I think pharma space for sure is an interesting space to watch out for. With earnings growth, back to normalcy, the whole pain of CY 22 is behind. Given the pricing pressure is no more, valuations are also reasonable, are not very expensive. Uh, from a hospital space, I would think this way, that hospital is, again, selective hospitals will do well. I have my own reservation on taking a bet on sector as a whole, but there are good companies within the hospital space which will do well as a whole. But if you think from overall market cap point of view, from a hospital together, the overall market cap of the hospital space has gone up some 7-8x over the last 3-4 years itself. And the utilization levels of hospital in general, I'm talking about private sector hospitals with the listed names, have exceeded 70% plus occupancy, which is probably the best in the last 5 years. So we probably will enter into a capex cycle more for sector as a whole. So you need to be very watchful of the stocks that you choose in the hospital space. So yeah, a hospital space would be very very bottom up approach. Is that's the best way to sort of invest and think about it.
Thanks. Another question from Mr. Harsh. Is there any possibility of Nifty touching 21,000's level by Diwali? So, what's your
That's
take on that?
that's like flipping a coin, Harsh. So when you flip a coin, there are only two probabilities. So I would refrain. I mean, I will not. So I mean, this is, to be honest, the best the best way to answer to this question is honest. To be honest, that I don't know. But when you look out probabilities, so there is certainly some probability. But I won't like to think from that point of view, because again, in the near term, anything can happen in the markets.
Thanks. So, we'll wait for further questions to come in.
Yeah.
So, anyone has any question, please drop it in the chat box.
I mean, one of the question that I read was, what do you see the Nifty by 2030? So, the way I look at, I mean, see the way we have think about, the construct of we clearly think that India, journey from $3 trillion to $10 trillion is, we are on its way to achieve that particular journey. Importantly, our per capita income of $2,500 will obviously clearly double in the next by the next 5 years. And the corporate will be the core participant in this particular journey, because without corporates growing, we don't sort of see meaningful changes. There's no way economy can grow without corporate participating enough. So just to think about it, if we end up even delivering a mid-teens growth in terms of earnings, and a similar sort of earnings profile is been matched by the delivery of nifty performance, you will probably see almost 3x nifty from the current levels between now and 2030. Because just applying by 14-15% CAGR means 56-57,000 index by 2030. And that's the way I think. Just don't hold me on for the number, but I'm just giving you a broad perspective of what the kind of earnings growth and what's the kind of nifty performance that you can expect. Because over the last 15 years, the nifty has delivered a I would say for a 15%, around 14 odd percent sort of growth over the last 15 years. So there is no reason to believe why the next 5 years, next 7 years will be very different from the last history that we know of.
So we have no further questions. Through. I think one has just come in. So another question from Mr. Sachdeva: which sector are you bullish as of today?
So, as I just alluded, we think consumer discretionary as well as building materials are the two sectors that we are bullish on. We think that's one of the, I would say, important sector to play participation of higher income in the country as well as disposable income, because real estate proxy building material is are the best way to play real estate proxies plus formulation of the economy. And I have spoken enough in the on the consumer discretionary sector why we are bullish on. And we think there are further legs to sort of that both growth and in terms of what market appreciates in terms of what kind of returns that we expected to generate.
Sure. Another question that our per capita income doubles to $5,000 by 5 years. Does this mean that manufacturing can also be looked as investment destiny?
Oh yes, the answer is yes. But my limited point is, when the per capita income will double to that number, you think about what are the first and the foremost where will the disposable income actually go to? You will probably not. I mean, to give you very layman sort of language, in a layman language, basic essential needs of a human being will actually get addressed an incremental amount that one particular earns. And this is proven in various markets, whether it's Vietnam, China, Cambodia, or any other emerging markets. Once that amount $2,000 income surpasses, you see massive disproportionate allocation to sectors or categories where where one was not able to spend. So wallet share of essential commodities keep dropping by, and wallet share of, I would say, discretionary commodities slash services keep rising. Which is why, in my understanding and belief, you know manufacturing is a critical component, but will not be the biggest beneficiary of a rise in per capita income for the country as a whole.
We have another question, Trilo. So how crude prices are likely to affect the small caps?
Crude, you know I would put this way, that crude in the last many years, due to geopolitical interventions, has its own bearing on the country, and we being a net importer of crude obviously has a bearing on it. So obviously higher crude has a indirect impact on the inflation in the economy as a whole. But if you ask me, uh, companies who have a significant raw material, in terms of power and fuel, will obviously the biggest negative impacted companies. But as a broader space, will it have a meaningful bearing? The answer is no. Again, we have to go into pocket by pocket, bottom up approach on what sort of companies are we referring to. So obviously, those who consume large amount of fuel slash power slash anything related to crude derivatives will have a bearing into it. But I don't, to be honest, we don't see a massive change in terms of earnings profile because of one particular variable. Obviously, we are talking about $80 to $90 of crude. We are not talking about $120. Where $120, the equation changes for the country as a whole. Forget about small cap or mid cap or large cap.
Sure. So there's a follow-up question that what if per capita income is increasing because of the increase in manufacturing?
So, sir, I'll just give you my perspective. The per capita. So, just think about it, right? A manufacturing. I mean, even today, an average manufacturing per capita, average individual income in engaged in the manufacturing is somewhere between uh, 25,000 to 35,000 rupees per month, which is basically nothing but annualized of around 300,000 to 400,000 rupees. And when you look at from a dollar perspective lens, it's it's still just or below the average that we're talking about. So unless we have a massive employment generation in the manufacturing, and we see a shortage of labor, skilled labor in particular, only then I would think manufacturing will cause to a significant significant increase in per capita income.
Anyone has any questions, please type them in the chat box. So we have a question on your views on IT sector.
We think and this is also prevalent from a portfolio allocation as well. We think IT sector already took up. So we think earnings of the sector have responded meaningfully well compared to the consensus expectations. Earnings have in fact delivered much better than what market estimated. And as we progress into by the end of CY22, we will probably see the year which began with an 85% probability recession in 85% recession probability at the beginning of Jan 23, we will end up the full year with no recession in sight. So what I'm just trying to highlight is the worst in terms of economic impact is probably the worst of the news is behind, and the earnings downgrade that most people anticipated haven't happened to the extent that we people thought of. So we remain constructive IT from on IT from a 3 year view. Because of two mega themes. One, the cloud migration after so many years is still 40% of the total IT, and the second mega theme of digitalization. Digitalization post COVID has just taken a big pace out. In 2021, it is now taken a pause. But the good news is there is no budget cuts globally by the spenders. Neither have we seen any deal wins reduction in the last 6 to 9 months. So we remain very constructive from a 2 to 3 year perspective. Next 3 6 months things could be volatile, as we all aware of, because of US and UK. But from medium to long term, we are very constructive on IT as well. And in
Sure,
fact,
thank you.
we actually added in our portfolios between February and May, across our mid, large, and small cap names.
Sure, thanks. So there's a question that do we have STP options in the portfolio? So Mr. Harsh, yes, we do have STP options in our portfolio. Trilok, you want to talk about some recent changes that we have done post to joining, something on that sort in our portfolio?
So yeah, I mean, in the portfolio, obviously, so I have done a few changes across both the portfolios, mid and small cap. Mid cap have seen a larger change because of obviously the need of the hour. So we obviously got in just we have we have got into further we have replaced from Bata, which is a company in the discretionary space, to Trend. We added KEI Industries, we added Balakrishna Industries. We exited from ICSL Lombard. We exited from Awas Financiers. We exited from Ultramarine in the small cap name. We allocated further capital to company like Sarah Sanitary, where we added capital to companies like Kajaria and Supreme Industries. So we have done a fair bit of changes over the last 8-9 months. The two three most prominent one are obviously taking more exposure to chemicals because we think the earnings are bottom out. Increasing exposure to discretionary and building materials, be it Supreme Industries, be it Trend, or be it sanitary ware, and trying to weed out the companies where we think that the earnings growth will sort of falter or will actually not grow to the extent that we thought of. Whether you talk about Bata Industries, ICS Lombard, Ultramarine Pigments, and and Awas Finances. These are the names that we obviously moved out of the portfolio. So that's in summary out of what the changes that we did in the last 8-9 months.
Thanks. Any questions, please type them on the chat box. Look, we have another question from Mr. Kumar. As lots of PSU small and mid cap stocks are in manufacturing and capital goods, as economy does well due to domestic consumption, so mid and small. What's your view going forward on PSU as a space?
See, I think PSU as a space, I won't, you know, blatantly say all PSUs are not doing good. Some PSUs have certainly improved over the last 3-5 years, either in terms of execution or in terms of opportunity scaling or in terms of leadership. But I would leave to believe that there are two, three. I mean, in particular, two pertinent issues with the PSU. One, the decision maker eventually at the end of the day is the government, who will decide what needs to be done and what how it needs to be done. And two, you need to be very wary of what valuations are you ready to pay for a particular sector or a company, because sustainability, the company in this particular space have not demonstrated consistent earning growth. That's my limited submission to you. We're not saying that these are bad names. Obviously, we need to be very, very. In fact, we think some names are very, very good, but we need to be picky and choosy what must be sort of invested in. Uh, and obviously, I leave it to the individual judgment on what they believe. So, we think in PSU in manufacturing, anyways, are not very, very. I mean, not too many, and there are hardly any few names that I can recollect of. So, Gaurav, there is one more question, I guess, on is investing in small cap more profitable than blue chip over 5 years' time? The answer is definitely and resounding yes. My views on pharma I've already shared, I think so a few minutes ago. So, pharma, obviously, I just said, right, the worst is behind and earnings will progressively get better as a, pro- as a massive pricing issue in US pharma, generic pharma pricing is now behind us, with domestic anyways doing very well over the last 18-24 months.
We have another question. Are you guys open to investing in IPO companies?
I think the regulation prohibits us in a PMS structure. So we are open to the idea, but obviously we don't participate during the primary issuance, but we obviously participate once it get listed on the exchange.
So another question is that what's the AUM of Ambit Asset Management? Just to answer that, currently we manage close to 3,000 odd crores in terms of AUM that we manage. Maximum AUM that we have is in our Ambit Coffee Can strategy, which is close to 1,000 odd crores. So I think we can end our call for the day. And any questions, please reach out to the respective RM, or you can even type us. You can reach out to us on the email, which is amsales@ambit.co. I'll repeat, amsales@ambit.co. Thank you so much, everyone, for taking out your precious time and joining us today. We will soon organize another call for another portfolio. Thank you, Trilok, for your time.
Thank you
Thank
very
you
much.
so much, everyone, for
Pleasure.
joining me today.
Thank you very much.